Hello. My name is Momita, and I'm the Senior Marketing Manager here at SEIU Member Benefits. I want to welcome you all to the Student Loan Workshop. We'll just give another minute and then we'll get started with the housekeeping. Okay, I think we'll get started now. Nathan, would you like to take us through the English-Spanish interpretation instructions, please?
Yes, thank you. Muy buenas noches. Esta reunión cuenta con interpretación en vivo. Para escuchar el español desde una computadora, haga clic en el globo terráqueo que dice Interpretación en la barra inferior de la ventana de Zoom. Luego haga clic en español y ya está. Desde un celular o tableta, pulse en los tres puntos o en la palabra más abajo a la derecha. Si no los ve, deslice la barra inferior hacia la izquierda para revelarlos. Pulse Interpretación de idioma, luego Español y por último pulse más arriba en Finalizado. Asegúrese de elegir un idioma, bien sea el español, o el inglés. No se quede en el canal predeterminado apagado. Muchísimas gracias. Thank you very much, Momita.
Thank you, Nathan. I'll just repeat that the non-Spanish parts, if you can't hear or see our screen, we recommend that you log out and log back into Zoom. There is a Q&A at the bottom of your screen. Please direct your questions there. We'll try to answer as many as we can. You can also ask your questions in Spanish. And we will distribute the recording and additional materials via email after the webinar. Do you want to move to the next slide?
All right, great. Thank you so much, Mamita. And hello, everyone. My name is Lindsay Clark, and I'm the Chief Borrower Advocate here at Savi. And I welcome you all for joining us here this evening or this afternoon, wherever you might be tuning in from. And I'm excited to talk to you all about your student loan debt tonight. I know it can be overwhelming and complicated, but that's exactly why we are here. So just to take a quick look at the agenda we're going to cover over the next hour, first, we're going to walk through some of the basics around your federal student loans. These are some of the most important things that you should know and understand as a student loan borrower to set you up for success. So we're going to talk about things like your student loan servicers. What are they and what role do they play? Different types of repayment programs, and even forgiveness programs like public service loan forgiveness. Then we're going to transition and talk about some of the more recent and major policy updates that have been happening in the world of student loans. Whether you've been paying close attention to the news or not, a lot has been going on. So I'm going to try to recap everything for you in just a few minutes so that you can be aware of some of the important things and changes that are happening and how you can take advantage of them. And then we're going to finish the webinar tonight by talking about the SEIU Student Debt Navigator, which is powered by us here at Savi, and how it can play a powerful role in helping you navigate through these repayment and forgiveness programs so that you never feel alone. All right, so we're going to first talk about understanding federal student loans, the basics. And here are a couple of the topics that we're going to touch on. As I mentioned, student loan servicers, what these companies do, how they manage your student loans, and what role they play. We're going to talk about the different types of federal student loans. This is a really important one because many borrowers are unaware of the type of federal student loan that they have. And it's important because the type of federal student loan that you have is going to impact your eligibility for some of these repayment and forgiveness programs. So we're going to go through the differences in just a few minutes. We're also going to talk about income-driven repayment plans. This is a powerful way to help lower your monthly payment. So we're going to talk about what's involved and how to enroll. And then we're going to wrap it up by talking about a program called Public Service Loan Forgiveness, or PSLF. And this is a powerful way to have the remainder of your loan balance forgiven if you work for a qualifying public service employer. So we're going to go through all of the requirements of that program and how to apply. And as Mamita mentioned, if you have any questions throughout the presentation, please feel free to put those in the Q&A. We hope to have time left over at the end, and I'll be able to answer some of those out loud. All right, let's start off by talking about student loan servicers. So these are companies like you see on your screen right here that are contracted by the Department of Education in the repayment and management of your student loan. Okay. So your loan is disbursed by the Department of Education. Okay, that's who owns the loan. But then it is given to one of these companies, and not all of them are on this screen right here. So if you don't see your servicer, don't worry. But then it is given to one of these companies to manage. So this is the website that you would usually log on to see your monthly bill, monthly payment, right? Set up that auto debit. And that's usually how you are sort of interacting and managing with your student loans when they go into repayment. Now, just one thing that I want to clarify, Savi is not a servicer. You can kind of think of us more like a facilitator or an intermediary or even an advocate on your behalf. So we might do things like submit an application on your behalf or get on the phone with you and your servicer to resolve an issue. But we're never going to take the place of that servicer. So you're always going to want to continue making payments to your servicer, making sure you have access to your servicer account. Now, one important thing I want to mention about these servicers is that it's really important to make sure that your contact information is fully updated with your current servicer. Over the last couple of years, while payments have been paused, some of the biggest federal servicers out there actually stopped servicing federal loans. And what that meant for a lot of borrowers is that they were moved or transferred to a different servicer. And many borrowers were unaware that this had happened. So you want to make sure, first and foremost, that you know who your servicer is. And once you know that your contact information is fully updated. Now, you can find out who your servicer is if you're unsure by logging into what's called your Federal Student Aid ID account at the website studentaid.gov. And we'll put that link in the chat as well. Studentaid.gov is the official website for the Department of Education. If you've ever taken out a federal loan, it will be tracked there. And as soon as you log into your account, it will show you what servicer you have. So you just want to double check and make sure that you know what servicer you have and your contact information is fully updated. That's how they're going to communicate with you about bills and things like that. All right, we'll keep chugging along here. Next topic are the different types of federal student loans out there. And I will tell you, I'm a student loan borrower myself. I have a little over $200,000 in student loan debt. So if that makes any of you out there feel better about your own situation, then mission accomplished right off the bat. But I say this because as a student loan borrower, before I became a student loan expert, I had no idea what type of federal student loan I had. And like I said before, it's really important to understand what type of federal student loan you have, because it's going to impact your eligibility for certain repayment and forgiveness programs. So I'm going to walk you through these now. We're going to start on the left-hand side of your screen with direct loans. So the direct loan program is a federal loan program that began in 2010. So if your student loan was disbursed from 2010 to present day, there's a very good chance it is a direct loan. This includes direct subsidized loans, direct unsubsidized, and even direct consolidation loans. If it has the word direct in that title, it is a direct loan. It might even say DL, which stands for direct loan. Now, the good thing about direct loans is that they are pretty much eligible for all the programs we're going to talk about here tonight, including things like income-driven repayment and public service loan forgiveness. So if you have a direct loan, you are in the clear. Let's move on and talk about FFEL loans, FFEL loans, which stands for Federal Family Education Loans. This was simply the loan program in existence prior to direct loans. So if you have a loan that was disbursed before 2010, okay, so an older loan, there's a good chance it could be a FFEL loan. Examples include FFEL subsidized, FFEL unsubsidized, and even FFEL consolidation. Now, here's the thing about these FFEL loans. They are only eligible for one type of income-driven repayment plan, and that's called income-based repayment, all right? And they are not eligible for programs like public service loan forgiveness. However, and this is a big however, they can become eligible through a process called consolidation. Consolidation is a free federal process by which you are basically creating what's called a new direct consolidation loan out of older loans or existing loans, okay? So if you have a FFEL loan and you are interested in pursuing income-driven repayment plans and public service loan forgiveness, you will need to consolidate that loan in order to become eligible. And again, you can also do that at studentaid.gov. All right, moving along to PLUS loans. PLUS loans come in two varieties, Parent PLUS loan and Grad PLUS loan. So let's start with Parent PLUS loans. Many people think the student debt crisis is a young person's problem, a millennial issue, when in fact, the fastest growing demographic of student loan borrowers is actually ages 50 plus. It is parents taking out loans on behalf of their kids. And that's exactly what a Parent PLUS loan is. It's a loan taken out by a parent on behalf of a child, but in the parent's name. That loan cannot be transferred to the child's name. It is in the parent's name, okay? Now, just maybe by a show of hands, I'm curious because we've seen an increasing number of Parent PLUS loan borrowers on our webinars. How many of you out there have Parent PLUS loans? If you're able to show by raising your hand. Yep, quite a few of you, which is not surprising. This is the fastest growing type of loan out there. Now, here's the deal with Parent PLUS loans. Similar to those FFEL loans that I just talked about, in order to become eligible for things like income-driven repayment and public service loan forgiveness, those Parent PLUS loans need to be consolidated. So if you have a Parent PLUS loan and you have not consolidated yet, that is something you're absolutely going to want to do in order to become eligible for those programs. All right, Grad PLUS loans, as the name might imply, are loans given to graduate or professional students. And the good thing about Grad PLUS loans is that they are eligible as is for programs like income-driven repayment and public service loan forgiveness. So there's no corrective action that needs to be taken on those Grad PLUS loans. So if at this point you're already a little overwhelmed and confused because we've got a lot of acronyms, FFEL, PLUS loans, it's a lot of jargon that I'm throwing out there. That's totally normal. It just goes to show you how complicated this system can be. But the most important thing to take away from this slide is understanding what type of loan you have. And if you have a loan type like a FFEL loan or a Parent PLUS loan that requires corrective action in order to become eligible, you're going to want to take that as soon as possible. Last but not least, I just wanted to touch briefly on private loans. So of all the student debt out there, okay, 90% of it is federal. So only about 10% are private loans. But a lot of borrowers, myself included, have both a combination of federal and private loans. So private loans are obviously non-federal loans that are made or issued by a lender such as a bank, a credit union, a state agency, or maybe even your school or university. Some examples might include Wells Fargo, SoFi, Discover. Those are all private lenders and private loans. Now, unfortunately, when it comes to private loans, they are not eligible for any of the federal repayment, forgiveness, or relief programs that we're going to talk about here tonight. And unfortunately, there is no way to make them eligible. There's no corrective action like a consolidation that can turn a private loan and make it eligible for federal programs. So if you do have private loans and you are struggling or are interested in figuring out what options you might have, the best bet is going to be reaching out to your individual lender. Because there's no federal system by which all of them have to abide, each lender is going to have its own programs. And so you're going to want to reach out to your lender and see what options might be available to you. All right. We're going to keep chugging along here. Okay, now we're going to talk about income-driven repayment plans, or IDR. So income-driven repayment plans can be a powerful way to help lower your monthly payment. When it comes to repaying your student loans, there are two primary ways to do so. There's what's called the standard plan, and that bases your monthly payment on your debt amount and the idea that you're going to pay that off in 10 years, all right? So for someone like me with over $200,000 in student loan debt, on a standard plan, my monthly payment is going to be over $1,000 a month easily. Okay. Now, the Department of Education realized that many people could not afford to pay their monthly bill on a standard plan. It was simply too high, the more student debt that people accumulated. So they introduced what are called income-driven repayment plans. And instead of basing your monthly payment on your debt amount, okay, these plans base your monthly payment on your income. They also factor in things like your tax filing status, your family size, and your dependents. Okay, so I'll kind of give you an example of how this generally works. Generally, they cap your monthly payments at anywhere between 10 to 20% of your discretionary income. What they're really going to be looking at is what's called your adjusted gross income, or AGI. Okay, so that's going to be before taxes. So I'll give you an example. If you file your taxes as a single person with no dependents and an income of around $52,000 a year, that monthly payment is going to come out to around $160 a month. Okay, and it's sort of a sliding scale from there. So if your income is lower, that monthly payment is going to be lower. If it's higher, it's going to be higher. Okay, but there's no cap on income in order to qualify. So you could make $500,000 a year and still qualify for an income-driven repayment plan. Now, for every child dependent that you have, that can lower your monthly payment by about $50 per child. Even unborn child dependents count. All right. So that's why I say it's important that they factor in that family size. Now, if you are a low-income borrower, and right now on the plans that exist, if you are making less than $35,000 a year, you can qualify for as low as a $0 monthly payment. Okay, so that can be one of the most powerful ways to really lower that monthly payment and see that savings in real time. Now, there are 4 primary types of income-driven repayment plans. So you can kind of think of IDR, or income-driven repayment, as the umbrella term here. And then there are 4 different types of plans. There's what's called the SAVE plan. This is the newest plan that was introduced this past summer, and it was formerly known as Repay. There's the PAY plan, which stands for Pay As You Earn. There's IBR, which stands for Income-Based Repayment, and ICR, which stands for Income Contingent Repayment. Now, we're not going to go into the differences between these plans. A lot of it comes down to things like your disbursement date, your loan type, et cetera, things like that. What's great about the Savi tool that I'm going to show you a little bit later on in the presentation is that we're going to ask you some basic questions, and we'll be able to identify which of those plans is going to be best for you. So don't worry about needing to know sort of all the differences right now. But I'm kind of going to explain generally how these plans work. So there is an application. It requires that you attach supporting documentation attesting to your income. This can come in either the form of your most recent tax return or a pay stub from the last 90 days. If you are unemployed, you can simply indicate you're unemployed and you don't have to attach any supporting documentation, and you will qualify automatically for a $0 monthly payment. Now, you submit this application to your servicer. Your servicer reviews it and says, okay, Lindsay, you're going to be paying $160 a month on the SAVE plan. And it locks in that payment amount for the next 12 months. 12 months comes and goes, and you have what's called a recertification deadline. And by that deadline, you basically, in order to stay in the program, you need to resubmit a new income-driven repayment application with updated income documentation. Okay, so your most recent income documentation. And then your servicer will, again, review that and then say, okay, Lindsay, for the next year, for 12 months, right, here's the amount that you're going to pay. So from year to year on this plan, your payment amount could fluctuate based on any fluctuations in your income, whether that be an increase or a decrease. Now, after you've been on one of these plans for 20 to 25 years worth of payments, you are actually eligible for forgiveness. Okay, so you can achieve forgiveness on an income-driven repayment plan. All right, that's generally how these plans work. Okay, we're going to keep moving along here. Next, we're going to talk about a program called Public Service Loan Forgiveness, or PSLF. When we talk about forgiveness, This is a program that has been around since 2007. Okay, October of 2007 is when it was signed into law. And it is a program that is not going anywhere, meaning there's no risk to you all as borrowers right now of this program being removed. And in fact, because you all have student debt at this point, you will be grandfathered into the program regardless of what happens to it, if anything should happen to it in the future. So I just want to say that from the get-go. But public service loan forgiveness is essentially this. It is full forgiveness on the remainder of your loan balance, whatever that may be. It could be $5,000. It could be $500,000. It doesn't matter. Tax-free, so there are no federal tax implications here. All right. After you have made 120 qualifying payments. Now, what constitutes a qualifying payment comes down to these three things that you see on your screen right here, and you need to achieve them simultaneously. So number one, you have to work for a qualifying employer. That is any government organization at any level, federal, state, local, or tribal, or any non-for-profit 501c3. The only stipulation here is that you must work a minimum of 30 hours or more per week. Okay. Now, you can combine multiple or part-time employment to qualify for the program. So let's say you worked part-time at one qualifying employer and part-time at another qualifying employer. So long as both employers were qualifying, okay, so they were either a nonprofit 501c3 or a type of government organization, and so long as combined you worked 30 hours or more a week, you can qualify for this program. So you don't just need to be full-time at one institution or employer. So that's number one, qualifying employer. That's the most important. Number two, you have to have a qualifying loan type. And the only type of federal loan that qualifies is a direct federal loan. And this is why I made such a big deal about loan types a few slides ago. You need to have a direct federal loan in order to be eligible to have it forgiven under this program. Now, what if you have a non-direct loan, maybe one of those older FFEL loans or a Parent Plus loan? You need to consolidate that loan, all right, into what's called a direct consolidation loan. And at that point, it can become eligible for the program, okay? So that's number two. And then number three, you need to be making payments on that loan on a qualifying repayment plan. And the only types of repayment plans that qualify are income-driven repayment plans. It doesn't matter which income-driven repayment plan you're on. You can be on any one of the four, but you need to be on one of them and making those payments for the on-time and full monthly amount, right? So these are the three sort of qualifications in order to achieve what we call a qualifying payment credit. And you need to get 120 of these total. So this is basically sort of what this process looks like. As I said, you need to make 120 payments while meeting all three requirements simultaneously. So your employment, you need to work for a qualifying employer. Your loan type needs to be a direct loan, and your repayment plan needs to be an income-driven repayment plan. Now, after you make 120 payments, your entire remaining balance is forgiven. Like I said, whether that's $1,000 or $100,000, the entire remaining balance will be forgiven, and that forgiveness is not taxed at the federal level. Now, a couple important things that I want to make sure everyone is aware of, and these are often common misconceptions about this program. These 120 qualifying payments do not need to be made consecutively. They just need to be cumulative, okay? Meaning you just need to reach 120 total qualifying payments in order to achieve forgiveness, all right? However, you can only receive one qualifying payment credit per one payment per one calendar month, okay? Meaning in any given calendar year of 12 months, the maximum amount of qualifying PSLF credits you can receive is 12, okay? So if you have to get to 120 total, right, and you can only get a maximum of 12 a year, you're all very smart. You can do the math there, right? That's 10 years minimum before you can qualify for this program. There's no way to get that forgiveness sooner, okay? You can't double up on payments in a month and get double the amount of credits, or you can't make a huge lump sum payment and get more credits than you normally would, all right? You can only get 12 credits a year, okay? So it would be 10 years minimum. And again, that would be if you were making them consecutively, which you don't need to. For some people, it takes them longer than 10 years. for them to reach that 120 total, okay? All right, so hopefully that clarifies some of the common misconceptions about this program and what it takes to reach those 120 qualifying payments. Now, how do you apply for public service loan forgiveness? Well, the good thing is that there is only one form and one form only for this program, and it's called the PSLF Employment Certification Form. Some people might call it the PSLF application, the PSLF form. They're all talking about the same thing. This form needs to get signed by you, the borrower, and then it needs to get signed by your employer, any current or previous employers that qualify that you might have had. So I mentioned this program began in October of 2007, okay? Meaning any qualifying employment that you have had from October 2007 to present day is fair game. This program is completely retroactive. So let's say during that period of time, you've worked for 4 qualifying employers. Well, you're going to need to submit 4 employment certification forms, 1 for each of those employers. And that employer basically signs off. It's someone usually in HR. They sign off on your dates of employment, that you work 30 hours or more a week, and that they are a qualifying institution. All right. So again, if you have multiple qualifying employers, you will need to submit a form for each employer. Okay. So you're going to submit that employment certification form to MOHELA. MOHELA is the sole servicer in charge of the Public Service Loan Forgiveness Program. So even if you have Nelnet right now, if you are trying to apply for public service loan forgiveness, you need to submit that form to MOHELA. MOHELA will review that form and say, okay, Lindsay, you've got 50 credits so far. And what happens is your loans will actually move from whatever servicer you might have had currently to MOHELA. So every borrower who is pursuing public service loan forgiveness has MOHELA as their servicer after they've submitted these forms. Now, you can either decide to wait until you think you've achieved these sort of 10 years or 120 credits to submit those applications, but I really discourage you from doing that. Even if you've only been working for a year, 2 years in public service, you should submit that employment certification form now, and you should continue to submit it every year or every 12 months up until you reach that 120 qualifying payments. That way you can be sure that MOHELA is basically certifying your credits on a yearly basis, and you are inching closer and closer to that 120. All right, it makes the process a lot easier. All right. Okay, we're going to keep chugging along here. I'm just going to take a quick peek at the Q&A to see if there are any questions that we might be able to answer out loud. So I see one. Someone asks, what if you are self-employed and work for your own nonprofit? How would that work? So if it is a qualifying 501c3 nonprofit, it is eligible. You basically can submit your nonprofit sort of IRS form as proof. And you can have, if you have someone else working at the nonprofit, they can sign off on that form for you. But you can submit sort of your IRS, I believe it's the 990 form, maybe that's for 501c3 nonprofits, as sort of proof, instead of having to sign on your own. And MOHELA will accept that. So absolutely, if you are self-employed and that happens to be a nonprofit, that absolutely does qualify. Another question I saw come through, someone asked, if we forget to submit 1 year, do we lose out on that credit? Absolutely not. So this program is completely retroactive. So like I said, you could decide to wait until 10 years in to submit these forms for the first time. Like I said, discourage you from doing that. The chances of them making a mistake, it taking a lot longer because they've got to go back through 10 years of repayment and work history, right? Those all increase when you wait. So it's a good idea to try to submit it as regularly as possible. I would say no more than, every 12 months. But like I said, it's completely up to you. All right, we're going to keep chugging along here, but keep those questions coming, and hopefully we will be able to have some time at the end to answer the remaining questions in the Q&A. All right, now we're going to transition and talk about some of the major policy and program updates that have been going on. So this is going to include the end of the payment pause. This is a big deal. Hopefully most of you are aware that payments resumed just a month or so ago in October. So I want to make sure everyone is on the same page and knows what's going on there. We mentioned this a little bit already when we talked about income-driven repayment plans, but there was a new income-driven repayment plan announced this summer called the SAVE plan, and it is supposed to be the most affordable income-driven repayment plan to date. And then last but not least, we're going to talk about some of the servicer issues that borrowers have been experiencing since this return to repayment in October. We've heard firsthand from a lot of borrowers who are having issues with their servicers that have caused a lot of problems. And so I'm going to make sure everyone knows what's going on and how you can take action and steps to resolve those issues if you are impacted. All right, so first up, payments resuming. So hopefully everyone on this webinar is aware, but if not, we're going to go through this again. Payments resumed in October of this year, okay? Interest actually began resuming on September 1st of this year. And October, we saw basically the first wave of payments due. Everyone has a different due date. And so if you're unsure of what your due date is, the best place to check that is going to be your federal servicer. All right, so they should have sent you, a billing statement and a due date, and they should be communicating with you about your monthly payments. All right, and again, if you need to confirm, your servicer, you can do so by logging into your federal student aid ID account at studentaid.gov. Right now, for anyone out there who is pursuing public service loan forgiveness or interested in pursuing public service loan forgiveness, make sure you pay attention to what I'm about to say, because this is a huge opportunity for eligible borrowers. So during this payment pause period, okay, which began in March of 2020, right at the height of the pandemic, and basically lasted through August of this year. Okay, so 3+ years on pause. All right. For each month that payments were paused, so I believe a total of about 43 months total that payments were paused. If you were working for a qualifying public service employer during that time and taking advantage of the payment pause, right? So meaning you weren't making payments, you are eligible to receive PSLF qualifying payment credits for all of those months, okay? So that basically means without having to have made a payment at all, you could receive 43 PSLF credits towards the 120 total that you need to achieve full forgiveness on your loan balance. That's basically putting you a third of the way closer to full forgiveness without having to pay a dime. This is huge. Because again, normally under this program, you need to have made a payment in order to be getting one of these qualifying payment credits. Well, under the payment pause, you get credit for every month that payments were paused. All right. And the same goes for forgiveness towards income-driven repayment. So if you're not eligible for public service loan forgiveness, but let's say you are looking to pursue forgiveness under an income-driven repayment plan, those 43 months of payment pause count towards those 20 to 25 years under the income-driven repayment plan forgiveness, okay? So how can you claim those credits and have them certified and added to your total? Well, there's only one way to do so, and that is by submitting that PSLF employment certification form. So you're going to want to do so for at least the period of time that you were employed during that payment pause period and any time prior to that, all right? So again, want to make sure everyone is aware of that because it's a huge opportunity to have gotten significantly closer to full forgiveness on that loan balance if you are eligible for public service loan forgiveness. All right, moving along, let's talk about this new SAVE plan. So again, this was introduced over the summer and borrowers are able to enroll in this plan now. And it essentially is the, I would say, most affordable of all the income-driven repayment plans out there. But it's being rolled out in waves. So the first wave was rolled out this summer. And then next July, the second part of the program will come into effect and borrowers will see even more savings. Now, just to clarify, this new SAVE plan, SAVE, replaced the old repay plan. So for any borrowers that had been enrolled in repay, all right, they were automatically transferred to the save plan. Okay, they didn't need to submit a new application. You were automatically put onto this save plan. So a couple things about this save plan that make it so affordable and a little bit different from some of the other income-driven repayment plans. All right. First and foremost, any unpaid interest that remains at the end of each month, okay, will not be capitalized and tacked on to your principal balance, which means regardless of how little you might be paying on your student loan that month, and it could be as low as $0 a month, okay, any remaining interest that is not paid will not be added to your balance. And so that will mean that your balance will never increase as a result of interest. I'm sure many of you on this webinar can relate to this feeling. I certainly can. I speak personally right now that you've been paying on your student loans for months, not years, if not decades, and your balance has not only decreased, it's actually increased. Okay, I started out with about $150,000 in student loan debt. I now have over $200,000 in student loan debt, and I've been making payments since 2011. This is because of capitalized interest, okay? The interest that accumulates and goes unpaid each month gets added to your balance. And with the interest as high as it is, it makes it really hard to ever pay down that loan. So this new income-driven repayment plan is essentially going to prevent that from happening going forward. So like I said, regardless of how little you might be paying on your student loan each month, that balance will never increase. Now, unfortunately, it's not retroactive. So interest that has accumulated already up to this point will remain. But going forward, your balance will not increase further because of additional interest. All right, so that's one of the big things about this new save plan. And this was part of the first wave that went into effect over the summer. The second part is that the new plan will raise the amount of income considered non-discretionary so that no borrower making under 225% of the poverty level will have a student loan payment. So in other words, if you're making about $15 an hour, about $35,000 a year or less, you will qualify for a $0 monthly payment, okay? Now, if you're making more than $15 an hour, all right, you will also see your payment reduced because less income will be included when calculating your monthly payment. That's basically what that means. They're looking at less income when they are making the calculation as to your monthly payment, okay? So that's what has essentially gone into effect right now for borrowers who are applying and enrolling in this new SAVE plan. Then next year, July 1 of 2024, this is going to get even better. And under this new SAVE plan, they're going to be capping your monthly payments at 5% of your discretionary income for undergrad loans and 10% for graduate loans. So right now, all the other income-driven repayment plans cap it at anywhere between 10 to 20% of your discretionary income. So starting next year, this plan will cap it at 5% for your of your discretionary income for undergrad loans and 10% for graduate loans. If you have a mixture of the two, of both undergrad and graduate loans, it will come out to a weighted average based on the loan types and the balances. So it'll be somewhere between 5 and 10%. So that's going to, hopefully for many people, lower that monthly payment even more. Okay. There's also an element of this program that is going to allow forgiveness if you had a principal loan balance under $12,000 after 10 years. Okay. And again, that's going to go into effect next year as well. So you can actually see your options under this new SAVE plan and enroll through the Savi Student Debt Navigator that we're going to show you in just a few minutes here. All right, last but not least, and then we're going to talk about how you can get yourself set up with the SEIU Member Benefits Student Debt Navigator to help you navigate all of these programs. I want to make sure everyone is aware of some of the servicer issues that have been reported since payments resumed in October. So borrowers have experienced a lot of issues coming back into repayment, after 3+ years on pause. Some of these included their servicers not sending any billing statements or sending them late. Okay, so they didn't get a statement or an email or an alert letting them know when their due date was and how much was due until maybe the day before it was due, if ever. Okay. We saw servicers miscalculating payment amounts. So borrowers who were trying to enroll, let's say, in the new Save plan, and the servicer was coming back and saying, you owe $500 a month, and that was incorrect. In fact, they only owed $50 a month. We've seen this across the board. Servicers have been making mistakes when calculating these program income-driven repayment monthly payments. Okay. And then we've also seen absurdly long wait times. Borrowers who are having issues are not even able to get through on the phone lines to their servicers because the wait times are so long. We're talking 3, 4, 5+ hours on hold trying to get through to talk to someone. The Department of Education about a month ago actually released a memo calling out a lot of these servicer issues that borrowers had been experiencing. And so they are taking steps with these federal servicers to correct these issues and ensure borrowers are not experiencing any further harm. So a few that I wanted to mention. You may see what's called an administrative forbearance on your account as your servicer works to correct some of these issues. So, you might have applied for an income-driven repayment plan. That application took a while to process. And so they might have put you into an administrative forbearance while they are trying to work through these applications that are delayed. And so that basically means you don't have to make your payment that month, okay, until they have finished going through and processing your application. Now, if you continue to experience any of these issues, you can reach out to us here at Savi, and we're going to make sure that you have our contact information for help in resolving them. That's really, we play the role of an advocate for so many borrowers, and we are happy to help all of you guys figure out, how we can make sure that you are getting the best outcome possible here. In severe situations, if you have tried on your own to resolve this, you've tried contacting your servicer, you're still experiencing this, you can actually file and submit a complaint with the Consumer Financial Protection Bureau, or the CFPB. In our Savi Help Center, we have an article with step-by-step instructions on how to do that. That is the highest form of escalation for an issue with a federal servicer. And the CFPB looks out for borrowers and helps to regulate these servicers and make sure that they're acting accordingly. So that is always at your disposal as well. But again, Savi will always be here to help you navigate any of these issues if you are experiencing them. All right, so I now want to pivot and talk about the SEIU Student Debt Navigator that is powered by us here at Savi, because it can be a powerful way to really not only help better understand your student loans, but navigate successfully from start to finish around a lot of these programs. I know we've covered a lot of information tonight. It's a lot to absorb in one sitting. It's overwhelming. And so that's exactly why Savi exists. We try to make this whole process a lot easier and take on that work for you so that you can know that you're getting the best deal out there. So just a brief background on who we are here at Savi, because you might not be as familiar with us. We are a social impact technology startup based in Washington, D.C., and we were founded by student loan experts and advocates who've been fighting on behalf of the borrower for almost a decade. And they saw how difficult it was for borrowers like you and like me to navigate these programs on their own. So they developed Savi as a technology platform and a human service. So there's a technology aspect, and then there's an actual human expert aspect to help borrowers not only better understand their student loan debt and a lot of these programs that are out there, but like I said, to navigate successfully from start to finish and cross that finish line. But along the way, we try to make the experience of being a student loan borrower a better one, because I think we can all agree it's not great. And so we try to do that by unlocking as much additional savings as possible through things like income-driven repayment plans, and then making sure that we explore your full range of eligibility around forgiveness programs like public service loan forgiveness. We are a registered public benefit corporation, which means it exists in our mission and charter to serve the public benefit. And that's exactly why we do things like this here tonight. We actually host educational webinars on a daily basis for our various communities of borrowers across the country, because we firmly believe that when borrowers are better educated and more informed about their debt, they're more empowered as consumers. So what that really looks like is that Savi is an easier way to manage your student loans. We simplify and digitize the eligibility and enrollment process for both federal repayment and forgiveness programs. So we're going to ask you a few simple questions, and then from there, you can basically submit applications to a lot of different programs. And then we track and monitor those applications with you to ensure they achieve the desired outcome. The best part of all is you get access to one-on-one support from student loan experts like myself every step of the way. And on average, Savi users are able to reduce their student loan payment on a monthly basis by an average of about $150 a month. And our average user receives forgiveness of around $20,000. Right? So without further ado, I want to make sure that all of you have access to the SEIU Student Debt Navigator powered by Savi. So you can get started by going to the link you see on your screen here, seiumb.com/getnav. And hopefully one of my colleagues will be kind enough to put that link in the chat for easy access. All right, again, that is seiumb.com/getnav. And I'm going to walk you through just a few screens to give you an idea of what's involved and how easy this process can be to get started. So once you've gone to that link, we're going to ask you two pretty basic questions to get started. And that is your expected income for the current year, this year, 2023, and what your current student loan payment is. And just by using those two numbers, we're going to be able to get this process started. And this is where we're going to be able to collect, or we're going to need to collect some more information to help us more accurately give you an idea of what you're eligible for and what your best options are. You can kind of think of it almost like a TurboTax, but for your student loans. So we're going to ask you some basic questions around your family size, your tax filing status, your dependents, your income, right? All these things factor into the assessment around income-driven repayment plans, okay? We're also going to ask you about your employment. This one is really important to help identify your eligibility for forgiveness programs like public service loan forgiveness. We have a database built into the tool of every public service employer in the country. So if you start typing in the name of your employer, it should pop up from the drop-down menu. You'll be able to select it, and then we'll ask you some further clarifying questions. Now, I highly encourage you to add any current or previous employment you might have had. This is only going to help us refine our estimate around your eligibility, because remember, these programs are retroactive. So if you've worked for previous qualifying employers, then you might be a lot closer to forgiveness than you think you are. And then the last step in the process is syncing your student loans. So we provide a loan sync through a technology called Plaid. It's best-in-class syncing technology. If you have a Venmo account, you've used Plaid before. It's used in most financial technology applications these days. What it allows you to do is to select your servicer. So let's say Navient in this case. Enter in your Navient username and password credentials. And it's going to basically sync over a read-only snapshot of your student loan data. So it's not giving us access or anything like that, but it's taking a snapshot of some of the most important data points that we need to know in order to be able to provide you with the most accurate assessment of what your best options are going to be. So things like your loan type, your disbursement date, your interest rate, your balance, right? These are all things that you probably don't know off the top of your head, because most borrowers have on average about 6 different loans. And so this allows all that to sync right over. And what's even better is, let's say you don't know what type of loan you have. We made a big deal about the types of federal student loans, whether it be direct or FFEL or Parent Plus loan, right? Well, when you sync your loans over, if you have a loan type that would require corrective action of consolidation in order to become eligible, we'll be able to detect it and we'll flag it for you and help you with that process. So we're always putting in those safeguards to make sure that borrowers don't have to know or think too much about their student debt. We try to make it as easy and user-friendly as possible. And then after you've synced those student loans, you reach the final step here, what we call the plan options page. And this is where we show you exactly what your best options would be. So you'd be able to see things like what that new monthly payment could be. And look, this is on the new save plan, right? So we have that available and calculated into our platform. So what that new monthly payment amount could be, what that total payment over time would look like, how long until you'd be eligible for forgiveness down to the year and month, and how much in forgiveness you'd be eligible to receive. It is highly accurate, this calculator, even more so than the calculators out there that are sometimes on the Department of Education website. In fact, oftentimes borrowers will go through and see that they have a lower payment on this Savi calculator, and that's when they realize that their servicer made a mistake in calculating that monthly payment. So I think it's a good idea, especially given all the issues borrowers have been seeing, to go through and just double check, to make sure that you are actually paying the amount that you should be paying. All right, now you might see a couple of different plan options presented to you. You might be eligible for a couple of different income-driven repayment plans. So you can expand below and we'll show you all of the things that you're eligible for. Now from there, you have the option to either submit these applications and paperwork on your own under what's called our DIY option. So we'll provide you with instructions in the applications for you to do that on your own, and that's completely free, right? Every federal student loan borrower can submit those and should be able to submit those at no cost. However, we know how difficult and burdensome these applications can be, and how difficult it can be to manage these applications with your servicer if you run into issues. So we provide a service called Essential, and for $40 a year, it is 100% money back guarantee. But Savi will take on all of the administrative burden for you and pre-fill, digitize all of your forms and applications, submit them on your behalf, monitor them to ensure they are accepted by your servicer, there are no issues, and you're on the right track. And you get access to one-on-one support with our student loan experts whenever you need it, via email or telephone. Okay, you can talk to a human expert like myself, like we have my colleagues on the webinar here tonight that are ready and able to help you with whatever you need. So kind of a look at what that Essential membership includes, again, for that $40 per year. And that price is just exclusive to SEIU member benefits members. So that is a special price for the union. So basically here on the left-hand side, you can see someone with 3 different employers and 3 different employment certification forms that they're going to need to create. Well, with that Savi Essential, with the click of a button, they can click Start ECF. It's going to pre-fill and digitize that form. It sends it to the borrower to sign off on electronically, and then we actually send it to your employers for you, both your current and any previous employers you might have had. So there's no having to print out that form, drive an hour to get someone in HR to sign it, et cetera. We do all of that for you. It's all managed right through your Savi account. And on the right here is an example of that pre-filled, digitized, income-driven repayment plan. Again, you could do this all on your phone in about 10 minutes. We have a DocuSign integration that makes it really easy to attach your income documents, to sign off on that form and get that submitted without any error to your servicer right away. And then once those applications are submitted, we work with you to monitor and track their progress to ensure they achieve the desired outcome. So again, you'll see here someone on the right with a couple different employment certification forms for their public service loan forgiveness, as well as their income-driven repayment application, all monitored from one dashboard. And then you can kind of zoom in here on the left and see exactly where you are in that process. what's been submitted on your behalf, what you might still need to do, estimated wait times, etc. It's all laid out right there for you so you can see exactly where you are in this process. One of the most frustrating things I find as a borrower and when talking to borrowers is the lack of transparency that many people have into what's going on with their servicer. I'm sure many of you can relate. You've submitted an application for something and you don't hear anything for a month or more on end, and you're left to wonder what's going on. Well, this helps to solve for that. And anytime you log back into your Savi account, you'll see your Savi dashboard. This is sort of like mission control for everything Savi, and where you'll be able to pick right back off from anything that you might have started. It's also where you can register for any number of our live and interactive workshops. We're actually hosting another one for all of our Savi users tomorrow at 4 p.m. Eastern. You can see the full lineup of events right from your Savi dashboard. And again, you can always upgrade to that essential at any point in time from that dashboard as well by clicking select a plan. But again, you can get started absolutely for free in using Savi. Enter your information, see your best options absolutely for free. It's totally up to you whether or not you decide to enlist our help and those premium services as part of that essential upgrade. And last but not least, our customer support. So if you have issues, you need help, you can click contact support. We have a really interactive help center with tons of great content and articles that you can read. You can send a message to our customer support team through your Savi account at any time of day, or you can give us a call weekdays from 9 a.m. to 5 p.m. Eastern. And I'm going to put that number on the screen here in just a second. All right, so I know we are running short on time, so I want to make sure we sort of recap, some next steps that you can take from this webinar. So first, you want to make sure you access your Savi account from the SEIU MB Student Debt Navigator. So you can do so at the link you see on your screen right there, seiumb.com/getnav. Then you want to complete the information in your Savi account so that we can show you what those best options are. And if you choose to do so, upgrade to that essential so that we can get those applications submitted for you. But most importantly, reaching out for any assistance along the way. That's exactly why we're here to help as many of you as possible. So you can send us a message through your Savi account, or you can give us a call at the number you see on your screen right here, 833-382-3175. All right. I know we've only got a minute or so left here. So before I close it out, I'm just going to take a quick peek at the Q&A to see if there are any questions I might be able to answer out loud. But if we didn't get to your question, best bet is to give us a ring at that number or to send us a message through your Savi account. Let's see here. Okay. It looks like some of these might be, our team might be in the middle of answering a few of these. I just saw one that came through. Someone asked, does Sallie Mae count as a private loan? So at this point, if you have loans with Sallie Mae, yes, they are private loans. Sallie Mae stopped servicing federal loans a while ago. So if your loans remain with Sallie Mae, that is a private loan. And how much is a Savi membership? So it's completely free to get started and to see your best options. But if you choose to sort of enlist our help with all the applications and that one-on-one support, that comes at $40 a year, not a month, a year. And it's 100% money back guarantee, meaning if you are not happy with the services or do not find them valuable, you can request a refund, no questions asked. All right, Mumita, did you want to say any final words before we close out and send everyone on their way?
No, I really wanted to thank you. I think this was all very important information, and all the contact information is right here on our screen. So please log into your seiumb.com account, and you can access the Savi platform or the phone number listed here. That is the best way to contact them. I really appreciate your time, Lindsay. Thank you so much for taking us through all this valuable information.
Yeah, thanks to all of you for taking time out of your day to join us, and we really look forward to helping you. Hope everyone has a great rest of the day.
Thank you all.